Hi everyone, this is a discussion of the Xpeng investment case. It's August 21st and the last closing price of the stock is $20.37. Currently we are in pre-market trading. Stock is at $20.43. Before we dive in, let's get some of the basics out of the way. Market cap, as you can see on the slide, is at $18.4 billion. The stock trades at a beta of 2.5 times. I will be discussing why this is important later. Next earnings date is estimated for November 18th. I say it's estimated because the company announced roughly 2 weeks before the actual date of the earnings report. But this gives us a good indication. This will also I will also discuss why this is important later. Then let's have a quick look at the long-term share price chart. So what you see is the last 5-year performance. And you can see that Xpeng exceeded temporarily $60 per share. Xpeng was also one of the EV bubble stocks that rallied significantly alongside other EV bubble stocks like Rivian, Lucid, NIO, Fisker, later Lotus. VinFast was one of the latest joiners. So all these stocks, what they all had in common is they significantly got ahead of themselves, and in some cases traded temporarily at truly ludicrous valuations. But all these companies that I just mentioned, they're all very different. This is first key consideration. And number two, for that reason, you should not think of them in the same way. So let's see. So Xpeng is over the last 5 years is down 12%, and obviously is massively down from the all-time high. As you can also see, stock temporarily dropped below $10 per share, but more than doubled since these lows. But this is ancient history by now. So let's look at a more recent view. So this chart does exactly that. Now we look at the year to date, and you can see the stock is up almost 72%, which would have made Xpeng obviously a super attractive investment. But you can also see that despite this phenomenal year-to-date performance, the stock was up even more earlier this year before the tariff announcements, and the stock even touched $26 per share. So currently we are over 20% down from that recent high. And when you look closely at the current share price of $20.37, the stock is effectively flat since end of February this year. So with that out of the way, let's look at the topics we're going to cover. Here you see a table of contents. Just real quick, we'll be talking high level a financial summary for Q2. The company just announced earnings a few days ago. We look at the share price, how it performed relative to index and key events. This brings everyone up to speed as to what happened to the stock recently. Then of course Xpeng is highly concentrated in selling vehicles, so we have to pay close attention to vehicle deliveries, market share development. We look at different ways how you can analyze sales trends. We also look at management's guidance, how the company performed relative to the company's guidance, to find out whether there is a consistent sandbagging or whether they are over-promising. This is important to assess the quality of the management and or whether management is prone to over-hyping, over-pumping the stock by putting out too aggressive guidance and not delivering on it. Then we take everything we learned from the first part and then we compress it down into a forecast. We will be discussing in detail then the key assumptions of the forecast and then of course the outcome of that forecast. We will also be discussing certain red flags and how you can analyze them. And we draw some conclusions from our observations of these red flags. So first, let's look at this high-level financial summary. So here, marked with this blue frame, the latest reported financial quarter. I covered up the forecast because we will be discussing that later. And there are some key observations. So first of all, when you look at the fourth quarter of 2023, I know this is ancient history by now, but it's important. You can see the company delivered 60,000 vehicles, but then in the first quarter of 2024, and this is not a typo, the company delivered only 22,000 vehicles. Yes, there's a massive drop in the first quarter in the Chinese market, and Xpeng at that point was almost exclusively a Chinese market vehicle seller. However, this still exceeds vastly what you would expect just from typical first quarter seasonality. So the key takeaways here, and you can see this in the numbers, the company went clearly through a rough patch, but subsequently worked these issues out. There was a recovery in the second quarter, strong recovery a further recovery in the third quarter of 2024, and then very, very strong in performance in the fourth quarter of 2024. I will not discuss in detail for each quarter the key drivers because this would take too long, so I give you just a high-level summary. So in the first quarter, there were various supply chain production issues, and then in the third quarter, or I should say really in the fourth quarter, Xpeng started launching lower cost products that were quite big hits in the Chinese market. Xpeng sold a ton of them, but I think that made a lot of sense because we saw something similar in other brands. So what you have to know about Xpeng is positioned as a premium brand in China, and what you can see also in other markets when a established premium brand launches a significantly lower entry to that brand, these vehicles typically perform well. We could go back all the way to, for example, Porsche. When Porsche expanded its product lineup to offer lower priced Porsches, those vehicles were huge hits. Because all of a sudden, a brand that was always unattainable to certain consumers was suddenly unlocked for that customer segment. So this is precisely what we saw in Xpeng. They produced a attractive product at a highly attractive price, especially given the brand power. And this then drove kind of an explosion in volume growth alongside other product portfolio upgrades. And for that reason, Xpeng did not experience the typical first quarter China sales weakness that every other automaker experiences, except for very specific outliers like Xiaomi, but it's a different story. And for that reason, Xpeng kept its significant growth pace. And later we'll be discussing management's outlook and what this means for the second half of this year for the company. The other important point I have to highlight on this slide is when you look at the revenue breakdown. So you have total revenue, and total revenue is driven by two segments. One is the vehicle sales segment, so everything related to the sale of new vehicle. And then you have services and other. And here is where something special comes in Xpeng's case, which is actually very similar to Rivian now. That segment does not only comprise all the typical automaker service-related revenue, like generating revenue from servicing vehicles out of warranty, merchandise, and various other auto sales-related services, but also Xpeng books in that segment the R&D revenue it generates from its collaboration with VW Group. And that's why I say it's very similar to Rivian, because Rivian is the other partner of VW Group. So there's significant overlap between these two companies in that specific area. And the interesting thing is Rivian did provide a lot of very specific guidance as to how the VW JV generates revenue. Xpeng did not. But the interesting thing is we can use what we know from Rivian and we can apply to Xpeng to actually improve our forecasting for that segment of the business. And at this point in the presentation, I need to brag a bit about my forecasting accuracy. It wasn't me if I didn't. So here is a post I sent after Xpeng reported earnings. The company reported 39 cents per share loss. I did a forecast, and here's the post, the receipt. You can find all of this on my X account. The day before, I posted to my subscribers on X, so this is not publicly available, but my subscriber saw it. I estimated a loss will come in at 39 cents per share, so I totally nailed it. Wall Street was completely off. They expected a $1.06 per share loss. So how did I do it? In my view, it's not rocket science. So all I do and apply this to all the companies I cover. I highly rely on management, but I do error correct management. So I always track their guidance, and then I calculate what was the error. And I also look at the specific quarter to assess whether there was a one-time item that caused them to be off or overly bullish or overly bearish. And then I take that error correction and apply to the latest guidance. And depending on how many data points they provide for an upcoming quarter, I do this for all these data points. And then what I do is I calibrate the model, i.e. I force assumptions to where they have to be to produce these error corrected forecasts management provided. Because let's be realistic, nobody has more information than management. They see daily order flows globally. And nobody has that type of access, and they know exactly at what prices vehicles are being sold. And no matter what research you do, you can never even get close to that type of data access. And that's why you should always base your assumptions on what management tells you, but you should not be naive and take everything at face value, because as you will see in this presentation, depending on the management team, they always have a significant underestimation bias, or sometimes they're being too optimistic. And that's why the error correction of management guidance is key. And my subscribers will notice I most of the time beat significantly Wall Street. So apparently this method works. But again, I don't think this is particularly brilliant. I find it quite straightforward, and I find it confusing that not more analysts actually deploy this method. So let's move back to the financial review for what else we can learn from this historical analysis. The second point is pay close attention to the services and other segment revenue line, and then at the gross profit. You can already see just by eyeballing the margin on that segment is enormous. Just to give you some reference point, in Tesla's case, the services and other segment, which is really mostly servicing cars, taking in money from paid supercharging, etc. That segment in Tesla is very low margin, typically less than 6% or even just around 3%. While here in Xpeng's case, you can see that when you look at the revenue in 4Q 2023, on 113 million of revenue, they generated 43 million in gross profit. So the margin is enormous. And then in Q1 2024, the margin you can see here was over 50%. On 138 million revenue, they generated 74 million in gross profit. And actually, you can see down here in this gross margin monitor for that segment, the margin development. So 54% in Q1 24, the following quarter 54%, 60%, 60%, and in the most recent quarter, so the second quarter of 2025, it was 54%. So enormous margin. So you can see clearly the effect of the VW Group joint venture. So what happens is VW makes direct payments to Xpeng, so that's 100% profit. But Xpeng has relatively little cost associated with this with these R&D services, and we see a very similar pattern in Rivian, and the margin is very similar for that piece of the business after you strip out Rivian's true service segment, i.e. servicing vehicles, etc. So there's already a lot of commonality, and this is very helpful in improving our forecasting. And let's move on. Operating expenses comprise research and development, selling, general and administrative expenses, and some other income that do offset some of these operating expenses. So it's a positive item in most quarters. We'll dive into these numbers later in much greater detail, because you always need to analyze OPEX on a relative basis, and here these absolute numbers are not that helpful. I just show them for completeness so people can actually work out the full P&L. And then we look at the operating profit, or I should say loss development. So these are all negative numbers. You can see that operating loss came down in the last year from second quarter of 2024, the 220 million loss reduced by 92 million. So operating loss was 128 million in dollar in the second quarter. So quite substantial reduction in losses, but still loss making. Then profit before tax, and then shareholders' net income was a loss of 65 million in the second quarter of 2025. So you can see that non-operating items had a quite substantial positive impact on the bottom line. The bottom line is shareholders' net income in banker jargon, or finance people jargon, I should say. And so this is something very important we should take into consideration. Then we need to look at cash, and cash, keep in mind, includes all instruments that are liquid, or all assets that you can quickly turn into cash. So there's often a mistake I see amongst people on X that analyze or report on the cash position of a company, but I'll dive into this point later. But the point is that Xpeng's cash position has reached a long-term high in the second quarter, and is now at $6.5 billion. And the leverage ratio is at relatively stable 30%. I also will be discussing why this is not an accident and why it's stable for this long. And then just total gross margin reported increased to 17.3%. So this is an all-time high, and it's actually a substantial increase over the first quarter, which kind of was expected because first quarter, as I said earlier, is seasonally typically weak. So if someone has actually a sequential increase in sales in the first quarter, this always bodes very well for the second quarter. And then we look down here at the operating margin. So operating margin is just you take the operating profit or loss in Xpeng's case and divide by total revenue. And you can see there's also a substantial increase. So last year in the second quarter was at 20% negative, and now it's down to 5% or 5.1%. And again, because non-operating items make a big difference in Xpeng's business still, the profit before tax margin, so profit before tax, which includes non-operating items divided by total revenue, has improved quite dramatically. So last year it was at 60.6% negative and is now reduced to negative 2.9%. But also take note that, as I said earlier, there were some rough patches. So in the fourth quarter of 2023, Xpeng already achieved a negative profit before tax margin of just 10.2%, and then later jumped more than doubled. So in the first quarter. So keep that in mind. It's important context. So with this high-level financial review, now go into sort of the key corporate events. So this is what this slide does. So first of all, I have to apologize. This is a very crowded slide, but this is a more analytical slide. That's why it's so full with all kinds of data. So first of all, how does this work? So the black line is the rebased share price of Xpeng. Rebased means that every share price is expressed as a percent of a given or held constant share price. And so this chart takes the last closing price of 2023, so that was on December 2029, and expresses all future share prices relative to that one share price. And the upside of this type of share price chart is that you can see percent changes rather than dollar amounts, which is from an analytical perspective much more useful than just dollar amounts, because frankly dollar amounts don't really mean anything. And then the other upside is you can then do the exact same thing for relevant indices, and for Xpeng, which is a Chinese stock, of course, we need to use a relevant Asia or also China relevant index, and that's the Hang Seng index, here shown in red. And then because we are looking at the ADR is basically the way you can trade Xpeng in the West more easily, I should say, and for that, also the S&P 500 is relevant, and that's why I also included it here. You always want to look at share prices relative to the most meaningful index. The way I look at it relative to Xpeng is S&P is more like a global equity markets measure, and the Hang Seng index more a local measure. And a few key observations. First, so over this time period, the Hang Seng index significantly outperformed the S&P 500. Hang Seng is up almost 50%, as you can see here. And then the S&P over the same time period is up about 35%, also a very strong performance. And Xpeng roughly is in line with S&P 500 performance, just a little above, and underperformed the Hang Seng index by roughly 8-10%. But you can also see that at times Xpeng significantly outperformed both S&P and Hang Seng. And this, for example, just happened a couple of months earlier, just before the tariff announcements. So again, I'm sorry, this is quite messy, but there's not really a great way to improve presentation if you want to pack this much information on one slide. So when you look closely, so what was driving this massive rally? Part of it we already learned on the prior slide. Xpeng's sales volume exploded in the fourth quarter, and that's why you already saw here quite a strong performance improvement. So we have to look at this fourth quarter. So Xpeng, when you look at the gap between the red and the black line, you can see there was a massive gap around summer last year, and then the gap narrowed significantly, and this was driven by Xpeng's significant sales outperformance. And then the fourth quarter was also quite strong, but then what I think people didn't have really on the radar was that Xpeng continued to increase volume even in the weak first quarter, and this then led Xpeng to significantly outperform the Hang Seng, and then Xpeng exceeded, of course, the performance of the Hang Seng, and there was a lot of other sentiment. There was full year results disclosure, and there was the typical buy the rumor, sell the news type of event going on. So you can see just prior to results disclosure, which happened on March 18th, Xpeng hit a peak at $26.3. What you also have to know about Xpeng, it's not just an EV maker, it's also a company that works on humanoids. Xpeng's founder and CEO is known to be a huge Elon fan. So I think he has he keeps a very close eye on everything Elon does. So Xpeng has also been working on humanoids for a few years now. They also work on flying cars. So Xpeng is also, for example, I don't think there's a Chinese version of Tesla, but if somebody put a gun to my head and forced me to give them a name, Xpeng would be within my top 2 that I will tell them. But again, I don't think there's a true Tesla, because a true Tesla means there was an Elon Musk. The two are connected, deeply connected. One doesn't, so Tesla doesn't exist without an Elon Musk, not the Tesla we know today. And because we don't have an Elon Musk in China, by definition, there cannot be like an equivalent company. And I think this kind of equivalent thinking is a lazy intellectual shortcut. But I digress. The bottom line is that Xpeng has a lot of hype potential. And this is also something in modern investing that is not only based on fundamentals, but also takes into account social media hype, meme stock trading, and all these things, which I believe is the future of investing, where all the hard and soft factors have to be considered, and the hard factors increasingly lose importance for outperformance. When you take these soft factors in Xpeng's case into consideration, and the fact that management is highly respected, you can see why Xpeng has significant potential in that regard. But of course, no stock can be too long, too detached from the fundamental reality. And that's why I believe a deep fundamental analysis should still be the basis of any investment case. And pure hopes and dreams and hype investing is ultra high risk. And of course, we always just hear from the few winners, but we don't hear from the army of losers, people who lost all their money or generated very mediocre returns for many years, who just jumped on the bandwagon without really thinking about the business, looking ever at the numbers. So bottom line of this chart is that stock hasn't really done much in 6 months. This is marked here with this red dashed line. So the rest of this presentation is about figuring out, is it a good moment to go long in this stock, or whether there is more downside looming. Now let's talk about Xpeng's latest sales trends. So the latest sales month is July, for which we have data. The company sold 36,700 vehicles. That month is up 229% year over year. You can see, as we discussed earlier, the company went through a rather rough patch in the first part of last year, but then saw a significant recovery by launching some very successful vehicles. And as I said, at a lower price point that had some important economic ramifications, which we will be discussing in a moment. But you can see there is, let's call it a somewhat flattening in the trend. And this is why we need to look at these numbers more closely and also need to bring in management guidance. Next, we look at market share in China. And since Xpeng sells well over 90% of its vehicles in China, this is the key markets we should focus our research. And you can see that this market share gain correlated significantly with actually the share price we just looked at. So there was an enormous market share increase, but also, and as we saw in this sort of flattening trend that I just mentioned, this has now come down again. Next, let's review Xpeng in the competitive landscape. This is what this chart does. This chart shows you sales on a last 12-week basis on a weekly basis. So this is latest data that you can see here. So this week it was reported that Xpeng sold over the last 12 weeks 89,820 vehicles. This is just a tiny bit behind Li Auto. And I on purpose grayed out all the other automakers because I don't want to focus too much on the other guys. Just want to give you an idea how is Xpeng traded relative to other key competitors. The other key competitors, let's just go through them real quick, is BYD, Tesla, Li Auto, Leapmotor, Xiaomi, Ito, which is owned by Ceres Group and Huawei, and then there's Seeker, which is owned by Geely, and then there is the NIO brand owned by NIO, obviously, but then also NIO has the Onvo brand and the Firefly brand. You can see that Xpeng was not among the top performers. The top performing brands were, up until very recently, Ito. And keep that name in mind, Ito is right now number 3. And you can see on this curve that they significantly improved and significantly improved their ranking, their sales ranking. Next, there is Leapmotor with a quite strong trend in sales. And then there is Li Auto, which actually sees a very negative trend in sales and is losing, it's dropping in the ranking. And then Tesla also saw a quite strong sales trend, but Tesla is at a very different level compared to Xpeng, sells a lot more vehicles in China. And then there's obviously the volume king, which is BYD, which sells a multiple of everyone else. But this comes at a very large cost, as I explained in other research I published. But this presentation is not about these other companies. This presentation is about Xpeng. So bottom line, so over the last couple of months, and you can see this trend goes back to late April, Xpeng was kind of flattish while there was a shift in rankings. And again, keep Ito in mind. Ito number 3, very strong performer. And this is important for the next slide. So this slide now shows you the last 4 weeks. So weekly sales totals per column. So in the last reported week, so the data that we just got a couple of days ago, Xpeng sold 7,900 vehicles. And this puts Xpeng at number 5th market position, just behind Ito. And as you just saw, Ito is number 3, behind Tesla and BYD. But Xpeng now outsold Ito at least last week and the prior week. Not by very much, but it did outsell Ito. This may not mean much, and Ito might quickly come back and sell more than Xpeng. But when you look at this long-term trend again, Ito's trend has been weakening, while Xpeng's trend is strengthening. So there's some early signs that Xpeng might actually improve further in its market positioning. But as always, you should never overweight one data point. You always have to. You should always take in a multitude of data points to come to a robust conclusion. So let's move on. Now we bring in for the first time management guidance. So these darker blue colors, or color I should say, is reported numbers. So, and as I said, the latest number is of time of this reporting is for July, for the full months. And Xpeng told us just a few days ago when they announced second quarter results, they expect to deliver 113,000 to 118,000 vehicles this quarter. So that the chart you're looking at is a trailing 3 months metric. So it always basically shows you, let's call it quarterly totals, because a quarter is 3 months. And as of a quarter end month, so that would be March, June or September, we can see in this chart the equivalent number to the guidance. So what I've done here is for September, I showed here the midpoint of the guidance Xpeng provided. And you can see if Xpeng wants to get to this guidance, we can expect a significant increase in sales in August and in September. Otherwise, this number is unachievable. But of course, you should never blindly trust management's guidance. And that's why you always need to check on their track record. And this is what this analysis does. So this chart plots for every quarter for the last couple of years management's guidance versus what was actually later delivered, aka reported. And then for the very last quarter shown on this slide, which is the third quarter of this year, for which of course we don't have yet the reported number, I show the forecast that flows through all the numbers that you see later in this forecast. So the green line marks the high end of the provided guidance range, and the red line provides the low end of the provided guidance range. And the black line shows you what was actually reported, and the blue line here in dashed as a dashed line shows you the forecast. And you can see for now quite a few quarters, the company never missed its guidance, i.e. it never came in at or below the red line, below the low end. In fact, most of the time it actually met or slightly exceeded the low end of its guidance. The most recent quarter, the second quarter of this year, was a outlier to that, we can say, medium trend. This did hold true for several quarters, but in the last quarter there was some deviation. The company did meet its guidance range, but it came in below the midpoint. The midpoint is the average of the high and the low point. So my forecast assumes conservatively that a similar outcome occurs in the third quarter. So there's some conservatism in my forecast, and you can see this here on the dashed line. It's so my forecast assumes third quarter sales that are slightly above the low point of the guided range. But the big picture is management's guidance overall is quite accurate. They're not over hyping or trying to pump this stock with putting out ludicrous sales estimates, because this strategy obviously would be very short-lived, because if management does this more than twice, investors would lose complete confidence in management. It would be a disaster. So of course their management guidance is quite accurate. And also the other factor you have to keep in mind, at the point of reporting, it's already at roughly the middle of the quarter. So at that point, their guidance is really only for around 6 weeks left in that quarter. And since automakers have at least a few weeks of high visibility due to order flows, etc., in reality, this is really just, call it a 4-week real sales estimate, because they already know the order intake at time of providing it to the market for about at least 2 weeks. So bottom line, there is, I would say, no surprise in the review of their delivery guidance. So now let's look at the full year guidance. So for the full year of 2025, the company guided for at least 380,000 vehicle deliveries. So the chart that you look at is a trailing 12 months chart. That means every bar shows you for the trailing 12 months the total sales. And so when you look at the December months for 2024, you can see 190,000 vehicle sales. That was actually the full year total for 2024, obviously then. And from the most recent month's perspective, July, the company is already at 361,000 vehicle sales. And you can see just by eyeballing, given that there are still 5 months left in 2025, achieving 380,000 vehicle sales, especially given that the fourth quarter in China is always the strongest quarter for almost every automaker, except they screw something up. It's exceedingly likely they significantly blow through this guidance range, and currently I expect them to come in somewhere in the 400,000 vehicle sales range, which obviously would then be a significant beat. But also helpful in Xpeng's case is that management provides revenue guidance. Revenue guidance is actually in many ways more useful and more meaningful than just vehicle sales guidance. But the two together are obviously even better than just one or the other. But let's focus on revenue guidance. So that's what you see in this chart here again. Green marks high end of guidance, red low end, and black marks reported, and blue as a dashed line is what's flowing through this forecast. You can see that the company clearly has an estimation bias. It always sandbags, because most of the time it comes in terms of revenue at the high end of its guidance range, and never gets close to the red line, the low end of its guidance range, and never drops below that. So management clearly very careful when it comes to revenue. This is why when we want to use management guidance for revenue forecasting, which we should be doing, it's very important that you correct for this estimation bias. And so what I have done is I've used the observable second quarter estimation bias and applied it to my third quarter forecast. So what you see on the slide is also what flows through the rest of the financial analysis, obviously. So on this next slide, we can see what this looks like. So I forecast for the third quarter of this year just over 2.8 billion in revenue, and then just under 3 billion for the fourth quarter. And that would imply that the company delivers 87% year-on-year revenue growth and would come in at 10.5 billion for the full year. And then I expect strong growth in terms of revenue in 2026. Obviously, the further out we go, the more speculative it gets. But my forecast is also based on observations I made in covering the entire Chinese auto sector, i.e. in terms of I cover all the large automakers in China. And although these growth numbers look ludicrous by Western standards, this is not unusual in China. And Xpeng's recent sales performance despite the stiff competition in China demonstrates their formula, at least currently, appears to be working quite well. So I do expect this trend to continue, although not as materially as previously. So that's why you see the sales trend to come down. But I still expect a strong growth of 54% in 2026. And a big part of that growth story is Xpeng's branching out into the highly popular EREV segment in China. So thus far, Xpeng is a pure electric vehicle seller, so battery electric vehicle seller. But the significant growth and scale of the EREV segments, so EREVs are extended range electric vehicles, so these are hybrid electric vehicles with a very large electric range, caused Xpeng to expand in that sector. And given the Xpeng formula worked so well, despite the stiff competition in the pure EV space, I do expect that this portfolio expansion will deliver results. And obviously this comes on top of likely ongoing further strong performance in its pure electric vehicle portfolio. Next we look at the revenue by segment. The primary driver, obviously the auto segment or vehicle sales, but then there's obviously also the service and other segment. And as I said earlier, this segment does not only reflect the typical auto service revenue, but also the R&D revenue Xpeng receives from its collaboration with VW Group. And here also another important factor is that VW just announced that they expand the collaboration with Xpeng for more aspects of vehicle development. This means that the revenue that Xpeng will receive from VW Group is highly likely to grow beyond the amount they received in the last few quarters. On top of that increased VW revenue stream into that segment, there is obviously Xpeng's growing vehicle fleet, which will also generate more revenue. And all these considerations are reflected in this lighter blue bucket, which is this which is this service and other segment, which sees also quite significant growth. Although in terms of relative size, it's dwarfed by the vehicle sales segment, obviously. But together, the two combined deliver this significant growth rate that I've been forecasting of 54% next year. Next, we look at the vehicle sales assumption underlying this revenue growth in the auto segment. So I expect Xpeng to come in the third quarter roughly at midpoint of their guided range based on my error correction assessment I explained earlier. And right now, because taking in announced product portfolio expansion, upcoming product portfolio expansion, the performance of recently launched vehicles, the strong fourth quarter seasonal factors I mentioned, I expect that Xpeng will bring in 122,000 sales in the fourth quarter. And this would get us, if you then add everything up, and again, we know the first 7 months already, we know the guidance for the third quarter, we know guidance is highly accurate, i.e. always comes in range. Effectively, we already know the first 9 months of the year. So all we have to do is to forecast the last 3 months of the year. So I really believe this is not rocket science, and this is why I'm consistently highly accurate. You just have to apply this rigorously. Don't take shortcuts. And when you do all this, what you end up with is 434,000 vehicle sales. And if you remember from the slide prior, management was guiding for at least 380,000 vehicles. And I'd like to point out, when a company says early in the year at least, this means they have very high confidence. So as long as things go fine, you should expect a meaningful outperformance over anything they mention that is at least that number. So and when we basically go through a thought process and take all this hard evidence that we already have as of August this year and all the circumstantial evidence, I believe it's highly likely that this will be a very accurate forecast, so 434,000 vehicles. There is a chance this might even come in slightly higher, obviously, but currently this is my best view. And whenever I model a likely long case, I tend to be conservative, and whenever I model a likely short case, I'm quite optimistic. This is just a good risk management strategy. So the key observation really is of all of that management is likely on track to beat deliveries double digit this year. So double digit means at least by 10%. Next, we have to talk about average selling price assumption. As I predicted last year, due to Xpeng's product portfolio expansion in the lower price segment, average selling price would drop significantly. You can see, for example, that in the troubled first quarter of 2024, Xpeng had a very high average selling price because it was only able to deliver in numbers its higher priced vehicles, but had other issues, and that artificially inflated the average selling price. This obviously had to come down, and then of course in the fourth quarter of last year, Xpeng started to launch lower priced vehicles. This further reduced significantly average selling prices, on top of course, all the intense price wars, which caused all the automakers to discount their vehicles, etc. So the average selling price, and I put here how it's being calculated, is not the sticker price, because the sticker price is not remotely what an automaker actually books in revenue. And that's why, from an economic perspective, what you always have to do is you have to look at what's the effective average selling price. And this is a number that you calculate on the financial statements of that automaker. Obviously, this is not a pure average selling price number. It's more, you should be thinking of it more as average vehicle revenue, because selling a vehicle is not only selling the vehicle. There's often accessories and other things that add to the revenue or subtract from the revenue in terms of discounts and inducements, etc. But this is not important for modeling and for forecasting. So when you look at the forecasted average selling price, so how does this work? It looks quite constant, and the reason why it looks quite constant is that I actually model vehicle sales, etc. on a model basis. So I have, and I can show you real quick. So I have all the models Xpeng is offering right now. So the G6, G9, X9, P7, P5, Mona, M03, G3, P7 Plus, G7. Their respective vehicle registrations were available. I have it for the vast majority of their sales. We know disclosed price ranges. You can apply assumptions as to the distribution within each price range. And then you calibrate the resulting revenue. This is what these percentages do here, to match what was reported in terms of auto sales. And this is where you can calibrate your model each quarter, because obviously there are the disclosed price ranges, but we never know exactly the discounts, etc. And that's why you want to do this price calibration, which provides quite a bit of insight, because here is the calibration factor for the first quarter, for example, here for the second quarter, and we can see there was an increase in calibration. Here the factor is negative. This means you have to reduce the implied prices, which means the price war even intensified in the second quarter. But despite the price war intensifying, Xpeng still delivered all-time best results. But this is a modeling minutia, so let's go. I mean, it's important, but probably most people are not interested in that, so let's move on. The net outcome of all of this granular work is actually what you see in this chart. The reason why it stays constant is because I'm not adding unannounced future vehicles. So I will update this consistently, and then this will reflect latest portfolio changes, but I do not speculate on what vehicles Xpeng might launch, because you also have to keep in mind that sometimes when a new vehicle launches, it heralds the end of another vehicle, because there is vehicle substitution going on in some cases, and not only product portfolio expansion. You have to keep all this in mind. But again, this might overall be a slightly conservative approach. But as I said earlier, this is something you should be doing when you look at a company that is most likely a long position. So then let's look at the gross margin that flows through this model. So first of all, what was delivered? So in the auto segment, the company delivered 14.3% gross margin. That is actually quite good for a pure electric vehicle maker. The other point that is important is the substantial sequential increase from the first quarter to the second quarter. Then the important thing is, how was the forecast modeled? So what I always do is I try to get management's guidance, because again, they have the best view because they have the most data. And Xpeng gave us some very important clues. For example, they said they expect first operational profitability in a single quarter this year. They also give us some guidance for expenses, R&D expenses, for instance. And they also provided the revenue guidance, full year vehicle guidance, etc. So you can take all this together, and you then, for example, they have their forecast operating profitability. This means you have to hit operating profitability. This means if you make a margin assumption and you're too low, you still don't get to operating profitability. You have to review your margin assumption. So this is exactly what I did, and I typically refer to this process as calibration. So I calibrate my model to hit management guidance on an error-adjusted basis. Since I do not have a time series, because management does not talk about this regularly, about operating profitability or losses, I have only one data point to work with. But because management's guidance has been accurate in the regular data points they provide, right now I assume the guidance is correct, and this is why I calibrated this model to produce an operating profit this year. And logic dictates that that quarter would most likely be the last quarter of this year, so the fourth quarter. Since, as I explained earlier, there's enormous seasonality that is highly beneficial for the automakers, and that tends to be always the strongest quarter for automakers outside of one-off events. So what you see is effectively that calibration in these margins, and then I basically kept them around 20% next year, because, and this is derived from a global auto company coverage, it's very hard for an automaker to get out of 20% gross margin, to meaningfully exceed 20% gross margin, especially when you offer not mostly premium product. But I covered this in great detail in some of my other research, so we move on. Now we look at the other segment, and again, this is where we see all the VW Group revenue coming in, and that's mostly pure profit, and that's why the margin is so high. So you can see that in the second quarter, the margin was 53.6%, and this is completely crazy high margin for that type of segment in an automaker. Because again, this is typical auto service revenue, which is low margin. Because the reason why it's typically low margin is automakers do not want disgruntled customers by charging them super high maintenance fees. This is, for example, also Tesla's strategy. Tesla talked about this many times. They do not want to make this a huge margin business, because this would mean charging Tesla customers when they come in for revenue a lot of money. And a big theme about Tesla is that buying a Tesla means a low running cost. And charging customers huge service fees would mean violation of that goal. We also see this in some other automakers that have a direct model. So this huge margin is really driven by VW Group, and we can see this in the numbers. We can see the first significant boost in this margin when the first agreement between VW Group and Xpeng was signed. So we jumped from around 30% margin, which is still very high for this type of segment, to then 50 and even exceeded 60%, and since then came down a bit. But I expect this margin to remain quite high, as there is more VW Group R&D services related revenue coming in. But I also account for the fact that there is other non-R&D service related revenue that is lower margin, which as the fleet grows will be dilutive to that margin. So the key thing to keep in mind with this significant margin boost from VW Group is that Xpeng should be able to generate outlier margins relative to peers that do not benefit from such high margin businesses. And this becomes highly visible once you look at gross profit by segment. This is what this slide does. So in the second quarter, of the 434 million in reported gross profit, 102 million came from that service segment. So that's a huge percent, given the, in terms of revenue, relatively small size of that segment. And as we already discussed, this segment is being expanded as VW Group just recently announced expansion of their collaboration. So we have to wait and see about the full impact, but I do expect a meaningful increase. And just like from a high level perspective, why would these companies make a big announcement around their JV expansion if this was like a small incremental increase? If this is a meaningful increase, worth of a statement by both companies, by both top management teams, we are not talking jump change here. This will not be like a few million extra per quarter. If both VW Group CEO and Xpeng CEO talk about it, this means there is what I think at least a 7-digit number involved on a quarterly basis. So, and this is what you see reflected here in these gross profit numbers. So we talked about how the revenue is derived, how the margin on auto is derived, and we talked about the other, so the service and other segment, and the net result is what you see here. So when we then look at sort of the outcome, so for this year, I expect total gross profit to come in at just over 2 billion. There would be an enormous increase over the 800 million from last year. And then I expect a more than doubling next year to 3.8 billion. But when you look over here in the income statement, gross profit is far from bottom line profitability. So we still need to look at all the other items, especially R&D spending and SG&A. So let's look at OPEX. So OPEX, or operating expenses, also as it's called, comprises all these elements. So there is R&D expense, selling, general and administrative expenses. Xpeng also includes a certain other income in the OPEX line, which is an offset, i.e. is a positive number amongst these negative numbers. And there is also some amount of fair value gain losses that is also included in OPEX, which is a bit unusual. But I'm not changing it because this is how Xpeng reports. So when you model a company, you should always set up your modeling in line with the disclosure of the company. So let's look at OPEX. So in the second quarter, OPEX was at 562 million. And that's up 49% year over year, so a massive increase, and 17% up quarter over quarter. But as we saw earlier, this was on the back of massive revenue growth. And I expect OPEX to come in at just over 2.3 billion this year. And we dive into the details in a moment, for a year-on-year growth rate of 36%. And then next year, I expect a continuation of OPEX growth, but at a lower rate, but still high rate at 31%. And this is driven predominantly by the overall growth in the business, Xpeng's significant growth in R&D expenses, and also importantly, Xpeng's announced increase in international expansion. Xpeng already sells outside of China. Xpeng is already present in Europe, in various countries, but the company announced to expand its international growth plans. So I made assumptions around all of that, and this is reflected in these numbers. The majority of Xpeng's operating expenses driven by R&D spending, and gladly the company provides R&D guidance. And here's an interesting point. The company pointed to 9.5 billion RMB, so that translates into roughly $1.3 billion in R&D budget for 2025. The interesting point is when you take in all of the other management guidance, especially around profitability, you don't quite get to their numbers if you take the full $1.3 billion R&D budget. You need to calibrate down a little bit by around 4%. So I think management projected R&D spend for this year, and then they applied a slight conservative buffer and rounded up to a nice round number, 9.5 billion renminbi. So my forecasting, because I was forced to not fully use the guided budget, accounts only for 96% of it. It's just something I should point out. And this is precisely why you see down here in the total for 2025 a total of 1.252 billion and not 1.3 billion. And this is not because rounding, and I'm not showing you enough decimal places. So with that out of the way, let's just talk real quick R&D spend. So Xpeng, as I said earlier, they not only invest in vehicles, but they also invest significantly in humanoid robotics. They have already a prototype walking around. There are even videos where you can see doing it some work. This also makes the company quite interesting, not because we can tell already they will be a winner in the humanoid space, no, but this provides always some hype potential, and you want to invest in companies that are not boring, because if a company has at least potential for some hype, it makes for potential outlier returns. And the company is also one that invests significantly in AI. For example, we know, based on company's guidance, that roughly half of the R&D budget is allocated to AI. So Xpeng invests significantly also in autonomy. Xpeng CEO last year visited a US test drove at Tesla, and after his test drive, he stated publicly that clearly pure cameras is the way to go. So I expect a strong R&D spend going forward. Then we need to look at SG&A spend. So SG&A spend is mostly selling expenses. Selling expenses comprise employee compensation, salaries, benefits, share-based compensation, bonuses for sales and marketing teams, marketing and promotional expenses, but also operating and lease expenses for stores that are directly owned, but also commissions for stores that are owned by franchisees. And I expect that part to increase meaningfully as Xpeng expands internationally even wider. But then there's also a volume element that will drive more SG&A spend as the business becomes bigger, not only in terms of additional footprint, but in terms of existing footprint. And the net result is what you see on this slide. This slide shows you efficiency ratios. So efficiency ratios here are defined as certain expense lines divided by total revenue, and the expense lines we are looking at here is SG&A spend in this light blue color, and then R&D spend in this darker blue color. And for example, in the most recent quarter, Xpeng spent 12.1% of total revenue on R&D and spent 11.9% of total revenue on SG&A. But despite what I just showed you, a significant increase in R&D spend and SG&A spend, efficiency ratios go down, and go down means they improve. The company is spending less per dollar of revenue on these expenses. And the reason is the significant expected increase in scale of the business reduces the relative spend. So this is clearly the effect of what people often would call economies of scale. Then this chart brings everything together. This shows you operating profit. So this is the net result of, you take total revenue, you subtract cost of sales, gives you gross profit or gross loss. And then you subtract all these operating expenses, and the net result is then operating income. And here, important what management said. Management said they expect in a single quarter in 2025 operating profitability. This is what this chart shows you. You can see that everything I presented thus far to you produces an operating profit of 10 million in the fourth quarter. So this is a tiny operating profit, but the company did not say, oh, it would be a large or medium-sized operating profit. It would say it would be operating profitable. And even if there's only $1 of positive operating profit, it would be operating profitability. But then they also forecast that throughout 2026, they expect consistent operating profitability. So all this is reflected in my forecast. But then, of course, when you look down here in this income statement, there are a bunch of other items. For example, all this non-operating items bucket comprising interest income, interest expenses, investment loss gains, FX losses and gains, and other operating non-operating items. As we discussed earlier, this actually makes a meaningful impact in Xpeng's case. So now let's look at them. So this is what it looks like. So you can see there's quite a bit of volatility, but the consistent element within non-operating items is net interest income and interest income and interest expense. So Xpeng has some debt on which it pays interest expenses, obviously, but then also on its cash balance, it earns interest. When I talk about cash balance, I always refer to all kinds of liquid instruments. Since the cash and cash equivalents position on a company's balance sheet is a very rudimentary view of a company's cash position. Since it's completely normal that a company takes excess cash that's not needed on a day-to-day basis and puts them in some type of investment to generate some yield, because it would be stupid not to earn interest on these large amounts while it's not needed. But the important thing is for a company, just from a liquidity management perspective, to make sure it's in a highly liquid instrument like a short-dated government bond, to be able to quickly liquidate that assets to extract the cash if and when needed without having meaningful valuation exposure. For example, if the company bought like a long-dated bond, 10-year government bond, this would also be a highly liquid instrument, but there's a risk that there would be changes in prices and interest rates, and then this long-dated bond, because of high duration, would have a meaningful drop in value at the time they need the money. And that's why companies prefer to invest in shorter dated instruments, even though the yield in typical market environment would be lower. So next, let's look at the bottom line. So that's shareholders' net income, or in Xpeng's case, it's also net income, because Xpeng has no non-controlling interest. And the way we get there is we take operating income, we just looked at, take off or add the non-operating items. We get to a profit before tax and before investees. So there's some income that is reported after the tax line in Xpeng's case. So that's income from companies Xpeng has invested in. So we take from profit before tax off taxes, and we add that income or loss in depending on the situation, and then we get to the GAAP net income in Xpeng's case. And this is what you see on this chart. So my analysis suggests that Xpeng will report its first ever GAAP profit in the fourth quarter of this year. The full year will still be a loss of 152 million, but then next year there will also already be a quite meaningful profit of 848 million. So the outlook is quite positive at the bottom line. But for valuation purposes, we need to go a step further. We need to look at the non-GAAP net income, and to go from the GAAP net income to the non-GAAP net income, you need to first adjust for fair value gains and losses. So you have to subtract fair value gains, these are non-cash items, or you need to add back a loss that was subtracted before, and then you also have to add back the expense on share-based compensation that gets you to non-GAAP net income. The reason why this is a superior metric for valuation purposes is, one, it removes the rather random volatility caused by fair value gains. Again, this is a non-cash item, so this can spike up and go away the next quarter and has no cash impact. But then also share-based compensation. So share-based compensation should be added back, because it creates consistency in methodology. Because when you compare share prices, you look at them on a fully diluted basis. Diluted means taking all outstanding instruments into account that create shares or give rise to claim of a share, and that's reflected in the share price. So if you use a basic metric, i.e. not diluted, it creates inconsistency with the share price. And if you use a metric that does not adjust for, let's call it, these equity claim holders, like share-based compensation, you're comparing apples to oranges. And now I'm really simplifying to make it really, really clear. So the share price reflects 100% of the equity claim holders. The GAAP income reflects, let's call it, 98% of the equity claim holders. So if you used now this, let's call it slightly lower number, you would inflate the multiple, because you divide share price by earnings. And if you don't capture all the earnings to all the equity holders, you use a too small a number, and that would inflate the multiple. So, and to eliminate this inflation of the multiple, this ballooning of the multiple, you add back the earnings that were taken out for some share of these equity claim holders, and this is the share-based compensation. This is also the exact same reason why in, for example, an enterprise value to EBITDA multiple, you have to add back interest expense, because enterprise value reflects the value that goes to both equity and debt holders. And that's why you need to add back the expense or the earnings that was already shared with the debt holder, and you need to come up with a metric that reflects both equity and debt holders. And that's why you need to add back these components of value, like in the EBITDA multiple, it's the interest expense, taxes even, depreciation, amortization. But this is not a video about multiples and theory and methodology. Just want to point this out, so that's why we move on now. The next thing we need is a number of shares, outstanding, diluted, forecast. So what you see here is, first of all, historical evolution, and you can see there was an equity raise. This equity raise was in the form of, number one, BW investing or buying 4.99% of Xpeng. The company issued new shares, sold shares, so it was equivalent to an equity raise, and this increased the share count in Xpeng. This is what you see in this increase. Then there was another increase in share count from Xpeng's purchase of Didi's smart EV assets. So Didi is basically an Uber type business in China. In my forecasting, and that's why it's bold here, I do not reflect another equity raise, because the reason is the company's cash position, provided the Chinese economy remains stable, I believe is adequate. There are some red flags which we'll be discussing in a moment, or I should say some issues, but I think the company is close enough to profitability and also likely positive cash flow. There is no need to raise more capital. This is actually a change to my recent position. Recently, I believed they would do another raise. So right now, I'm more like 60% they do not raise, and 40% there might be a small raise coming. But I will explain in a moment what flipped me now to thinking, no, they're not going to raise again. So the net result is that, and you can see this here in this forecast, I expect a dilution of roughly 1%. This is year over year, so that's not very much. And this is primarily driven by executive compensation and employee compensation via share-based compensation. And this, as you can see, is in line with historical quarters when where there was no equity raising. Then we get to the GAAP earnings per share, and this is shown here in dollar. And it's shown here in dollar because the ADR, so the instrument most people in the West will trade when they consider buying or selling Xpeng, is also in dollar. So this is simply what you see here in this purple color, the shareholders' net income, GAAP net income, divided by the number of shares that we just looked at. And you see here the outcome, and I expect for the next quarter a GAAP earnings per share number of a loss of 4 cents per share. And then in the fourth quarter, the model results in a profit per share of 4 cents. But again, for valuation purposes, this is not the best metric. The best metric is non-GAAP net income. But to get to non-GAAP net income, we first need to make the non-GAAP adjustment. So first of all, there is an item called fair value gains and losses. So the gains you need to deduct. So here in this chart, the gains that were recognized in the income statement are here shown as negatives, and the losses you also have to back out. So that's why you add them back. That's why they're positive here. But you can see, first of all, these are tiny numbers. So in the last quarter, there was a loss of 6 million that is added back. So this is not a needle mover at all. And also in all prior quarters, there was not a single quarter where this number was a needle mover. So I just include this here for completeness. And I do not, and you can see it net overall, it's broadly neutral, i.e. zero, close to zero. And that's why I do not forecast this item specifically, or I should say I forecast it at net zero. So let's move on to the next non-GAAP adjustment, which is share-based compensation. This is I would consider needle mover. And you can see in the second quarter, there was 17 million in share-based compensation. You can see it fluctuates quite a bit. When you read up on Xpeng's share-based compensation scheme, this is linked to share price. Share price is quite volatile, and that's why you see also volatility in this metric. So how are you supposed to forecast this? So my approach is I link it to the salaried expense base. We know that Xpeng employs in basically all categories, so people who work in production, so that would be reflected in COGS, have a component of share-based compensation, but obviously also people in R&D, especially in R&D, and then also in the SG&A area. So, however, in the cost of goods, so in production, it tends to be significantly lower. So my forecasting works out a relevant cost base and then looks at how that percent has developed over time, and then keeps that percent of share-based compensation relative to that salaried cost base constant. So, and as the business grows, we should assume that employees receive a similar percent in share-based compensation as they do right now. It would be kind of illogical to assume that the business grows and the percent of the payment goes down in terms of share-based compensation. No, it probably stays constant. It's also illogical to assume that all of a sudden Xpeng would start paying a higher percent of their salary in share-based compensation. So the best thing you can do is you keep it constant. And since Xpeng's founder and CEO is a huge Elon Musk fan, he might also take some clues from Elon's compensation strategy. And Elon is known to reward all employees with shares, so that everyone participates in the success of the business and aligns all interests. So this is also reflected in my forecasting. So after all of that, we finally arrive at the metric that we want to see, and that's non-GAAP earnings. So here, the share count here in this light green color we already discussed. Then here in this purple color I just show again the resulting non-GAAP earnings from doing all these steps. So the non-GAAP earning for the next quarter I estimate to come in at negative 14 million. It was negative 53 million in the second quarter. So I expect a substantial reduction in losses, and then I expect a non-GAAP profit in the fourth quarter of 61 million, and that will basically be a huge milestone for the company. But I'd like to point out that the company will only report that in March of 2026, so that there is quite a bit of time till we learn about it. But we should see the strong delivery sales obviously come in much sooner, because we get from Xpeng on a monthly basis deliveries, plus we get sales on a weekly basis out of China. So we can trace Xpeng's performance relative to this forecast quite closely. And then also in terms of announced price cuts and things like that, we can also calibrate margin assumptions. So that's why we don't need to invest now and hope everything will be fine over the next 6 months. No, we can adjust our positions depending on how the business tracks against the forecast. And then obviously with that knowledge can exploit the business getting ahead of itself should we see crazy rallies, or if there's significant sell-off that happens quite often in the Chinese market. So the bottom line is there is non-GAAP profitability incoming, so it's very good. And then there's likely consistent non-GAAP profitability next year. And the interesting thing now is, okay, what does this mean in terms of multiple? I would not recommend to calculate the current multiple for the next 12 months, because we still have loss-making quarters. And as we and you can see as we move from loss-making to profitability, that there is some, let's call it denominator effect, because you have a price divided by earnings, but earnings will be super depressed because we just move into profitability. So what I would recommend is you look at the next 12 months earnings from a March 2026 perspective. So when Xpeng announces fourth quarter results in March 2026, the next 4 unreported quarter obviously will then be the first quarter of 2026, the second, the third, and the fourth. So what I would propose to get a sense of valuation is sum up these 4 EPSs and then divide the current share price by that number. So this gives you conceptually an advanced view of Xpeng's March PE, 1 year forward PE, based on the current share price. But of course, I don't make you do this calculation. I did it, of course, for you. So the resulting multiple is 20.5 times. That is actually quite low for a company that obviously has enormous growth, just moves out of loss-making into profits, has all this high potential around humanoids, artificial intelligence, even flying cars. They also have a prototype for that, is led by a tested leader. Xpeng went through some very difficult times, as you saw earlier in this presentation, but they turned it around, and now the business is doing quite well. They're growing quite quickly, phenomenal sales success and improving margins. So all this looks very, very good. And you have a leader that is not jealous of Elon, but recognizes Elon for what he achieved and takes obviously clues from Elon, which is not a bad thing given how enormously successful Elon was. Oddly, a lot of CEOs, instead of taking a page out of Elon's book, they closed the Elon book and ridiculed it. That was a huge mistake, and there are a lot of people that did that. But Xpeng CEO is definitely not amongst them, and actually I think is quite smart. And also when you consider investing in a company, you never just invest in a company. You also invest in the leadership team, and arguably the leadership team is a lot more important than the current company. For example, if you would implant someone like Elon in probably any company, I guess the chance that he would improve that company is very high. I probably sound like an Elon fanboy right now, but the fact is, when you look at what he delivered, and I studied all his business quite carefully. I also studied the industries he's operating in quite carefully. So I know the competition, the financial resources of the competition, and a lot of other things. I know what he pulled off. And then to a lesser degree, when I look at Xpeng, what they went through and what type of competition they face, keep in mind they face off with Tesla in China. And they do manage to snatch some customers from Tesla. So this deserves respect. This shows you Xpeng is not run by some old Chinese guy who can barely read, who just got the position because he knew the right person in the CCP. No, the leader of Xpeng deserves a lot of credit, and that's why I deem him as a highly capable leader. And he's still relatively young, and so Xpeng, based on all of these high-level, let's call it soft factors, has a positive outlook. But also let's look at some of the red flags that I mentioned earlier. So on this chart, this is a balance sheet review of some key items. So here is the top line shows you the cash balance in dollar million. So the latest reported number is 6.5 billion, and this cash number does not just include cash and cash equivalents, because frankly this is a rookie way of looking at balance sheets and cash positions. When you want to look at cash, as I explained earlier, you always need to include all the liquid instruments, and here down in this footnote I explained everything that's included. So there's not only cash and cash equivalents, but you also need to include restricted cash, short-term deposits, restricted short-term deposits, short-term investments, restricted long-term deposits, the current portion, but also the long-term portion, and a few other things. Only then you get to the true liquidity position of the company. So this is what this blue line shows you. But this liquidity can be gamed by altering debt levels. For example, if you increase your debt amount, you increase your cash balance. Because, for example, if you take out a loan, just like in a consumer, the company takes out a 1 billion loan. That 1 billion, the proceeds go into your cash until you spend it, of course. But when we now analyze these lines, so let's go through the key lines. So the debt level is this dashed blue line. You can see it's actually decreased over the last few quarters a little bit, but overall broadly stable. So this was not driving the increase in cash. Then the next item is receivables. So receivables is amounts that other parties owe you. When receivables, the green line goes up, this is cash negative. When it goes down, you reduce the amount people owe you, you collect the cash. So this is cash flow positive, but also this line stayed relatively flat. Then the exact opposite of that is payables, but we paused it for a moment and we talked before we get to payables, to inventory. Inventory is this red line. When inventory increases, it's cash negative. When it decreases, it's cash positive. But also this line quite stable relative to cash position. Inventory not very much. So Xpeng did actually quite a good job despite its growing scale to manage inventory. So what was driving the increase in cash? If that stayed constant, the company did not issue equity over the last couple of quarters, as we earlier determined by looking at the share count. So what was driving it? And you can obviously clearly see it here on these curves. This gray curve, which is for payables, is almost a mirror image, not a mirror image, but it is almost in parallel with the cash balance. That means the company increased its cash primarily by forcing suppliers to finance them. And the way they did is they did not pay the bills, or they agreed with them very long payment terms. Because payables represents the amount Xpeng owes other parties, and in an automaker, this is always the suppliers. So when you look at the 3Q number, so at Q3, payables was at 2.3 billion, and now it has gone up to 4.2 billion. So that's an increase of 1.9 billion. This is funding to Xpeng. So suppliers increased the funding to Xpeng by 1.9 billion. Now let's look at the cash position change for the same time. So in the third quarter of 2024, it was at 4.9 billion. And now cash has gone up to 6.5 billion. So this is an increase of 1.6 billion. Suppliers provided, as we just said, 1.9 billion financing. So there's about 0.3 billion lost somewhere. I believe this is some amount of cash burn, so negative free cash flow. But we don't know for certain because, first of all, there are obviously other balance sheet assets and liabilities that have an effect that is not captured here. But more importantly, the company does not provide a cash flow statement on a quarterly basis. They only provide once a year with annual disclosure for the full year. So intra-year, we have a little visibility. There are ways to work out roughly how much cash flow they generated by using income statement metrics and balance sheet metrics. And what I present to you is kind of part of that exercise. But when we summarize everything, we know that on an operational basis, the business has already reduced losses to rather modest amounts. You can see this here in the shareholders' net income. Or better, you look at here at the non-GAAP shareholders' net income here in the purple box. So this year, losses came in 58 million, 53, and we don't know fourth quarter. But when we look at the 3 quarters that we looked at our balance sheet analysis, so we looked at Q3 2024 to the second quarter of this year. So that would be, in these quarters there was a loss generated of 191 million, 58 million. So this, if you add these numbers up, they actually add up to this 300 million. And we just established that the gap between the financing that we can observe from the suppliers, 1.9 billion, and the increase in debt, of cash was 1.6 billion. So 300 million is missing. So, and accidentally, the loss the company provided on a non-GAAP basis, which is a better measure of cash flow, is also 300 million. Non-GAAP earnings is not a great metric for cash flow, just to be very clear. But we don't have the exact data, but just on this, let's call it breadcrumbs, I think the overall picture kind of fits together. So and I can't go into all the details because it would take way too long. So my conclusion by reviewing everything, my conclusion is that the operational cash burn has been reduced to a minimal amount by now. But at the same time, the company wants to show a strong cash position, therefore pushed its suppliers to accept longer payment terms. And Xpeng is actually not an outlier amongst other Chinese automakers. I mean, they're quite high up, but they're not like significantly off, because a lot of the other Chinese automakers for which I have the data, they're also at a similar range. And when I talk about similar range, we really have to talk about DPO. So DPO stands for Days Payable Outstanding, which creates a relative metric from payables and cost of revenue, which is a much more useful way to look at payables than just looking at the absolute numbers, because these businesses have different sizes. So the DPO came in at 183 days. That means on average Xpeng pays suppliers at 183 days. That is quite high, but there are other players roughly in that range. And competition is very hard, and it's not only about selling cars, but also showing the best numbers. So the bottom line is, although this massive supplier funding extraction is not a good look, I'm actually not too concerned about it in Xpeng's case, because this is pretty much industry practice in China. I think companies will have to dial it down in the next couple of quarters. But on the flip side, some of these suppliers are huge companies, and the cost of debt for this large corporation is very low in China. So there is a financing arbitrage going on here. And the way Xpeng can actually, let's call it, reimburse suppliers for extending this financing is by offering them slightly higher margins on the components, materials they buy from them. But this is beyond the level I can analyze, because I do not have the disclosure for that level. It is not disclosed by companies. So what's the bottom line of all of that? And I think for that, I think it's worthwhile we go back to the beginning of this presentation. I think given that it appears highly likely the company will not only meet its full year guidance, but meaningfully beat it. And the strongest months of the year are still ahead. The ongoing strong AI theme. There will be Investor Day coming up for Xpeng. The company clearly doing a lot of things right. I think there's significant upside in this company. And of course, as usual, this is not trading advice. Investors should consider taking a long position in this company. And should there be significant volatility, i.e. the stock selling off, consider picking up shares on the cheap. But equally, should the stock really too far beyond the outlook, even though the outlook is strong, not shy away from taking profits. So before I let you go, I need to go back to this early slide I showed you, and where I talked briefly about the beta. The beta is 2.5 times, and I said I would explain later why this is important. The reason why this is very important is 2.5 times implies very high volatility. So really quick, beta implies that if the market moves by, say, 1%, you would expect, or in most cases, Xpeng would move by 2.5 times it, so would move by 2.5%. This very high volatility, this high beta factor, is great news for investors who actively trade the stock, because this means it frequently you get to buy the stock at low prices, and you frequently get to sell it at elevated prices. So even, let's say your outlook is, let's say the stock can do, I'm making a number up, so don't quote me on it, 30% over the next year. The return potential could be significantly higher if you actively monitor a stock and don't shy away and have the time to trade a stock. So you might be wondering now, okay, what do I think where a stock can go to? The reason why I haven't provided my price target on the stock is the stock is just entering a positive earnings phase. So for my type of valuation analysis, I need some historical period where I can observe a multiple to draw then some conclusion as to where where the company's share price could be based on an earnings outlook I can model. But what I cannot do is I cannot make up a multiple. That I leave to all the charlatans and stock market pumpers, but you will never get from me a made-up multiple. When I show you a multiple, it will always be quantitatively derived from observable market data. With that, I hope that was useful. Thank you very much for listening. See you next one. Bye.